Is the San Diego real estate market going to crash? Well, if you're thinking about buying or selling real estate in San Diego, here's what you need to know. Hello, my name is Mike Cuevas with Big Block Realty, and what we're chatting about in this video is going to address the elephant in the room. Is the real estate market going to crash? As of May 2022, what we've started to see in the real estate market is a shift. You know, in the last 3 to 4 years, we've seen some prices in the San Diego area escalate up to 40% in some cases in appreciation. So are we on the verge of another 2007, 2008 market crash? Now, I went through the market crash. I've been selling real estate since 2002, and I've seen 3 different cycles of real estate. And we've learned quite a bit from the 2007 to 2012 crash. And yes, there are some similarities to what is occurring today, but there's also a lot of things that aren't present. So what we're gonna do in this video is compare the two and then determine whether or not we believe there's a crash going to be coming. And the short of the answer is not a crash, but definitely probably a correction or a shift, which can mean good things if you're a buyer or a seller. So what I will say is that I am very skilled in real estate, but this is 100% my opinion. And what I want you to do is walk you through 4 things that occurred in the last crash in 2007, 2012 that aren't necessarily present today. And this is why a lot of us are believing that we're not gonna see necessarily a crash, but we will see a correction or a shift. How big that number is, we don't know, but let's get into what you need to know about this real estate market right now. Now, the first point that you want to take into consideration is that the demand, not just in San Diego, but throughout the United States, is extremely high. And for whatever reason, in the last 5 to 10 years, the US in general has not kept up with the housing demand. Housing starts are lower than they've ever been. New construction is lower than they've ever been. And unfortunately, there are not enough homes for sale. There's not enough properties to put people into. So the biggest problem that we have right now is the demand. Now, whenever demand is high and supply is low, that usually leads to an increase in prices, just like any other basic economic principle. However, one of the things you want to compare the two, when we crashed in 2007, the demand wasn't quite as high as it is today. We had an inventory of homes that people could purchase. Another thing that has come into the marketplace today in this market is that depending on where you're at in the United States, and yes, they are here in San Diego, is that there's a tremendous amount of institutional buyers. They call them iBuyers, Wall Street buyers that are buying single family homes, that are providing bridge type transactional funding. And the difference between this market and the last market was that real estate was not an asset class before. So my opinion is that until you see these funds, these high buyers or these type of iBuyers that are pouring billions and billions of dollars into the real estate market, they're doing a lot more research than either of us are, and that's gonna truly be an indicator. If you see one of these big, large funds like an Opendoor pull out of the marketplace, well, they've seen something that we might not have yet, and now it's time to pay attention. So overall though, the demand is still very high, and although the increase of interest rates may diminish the amount of buyers out there, the demand is still high, that there is a good amount of buyers, and when people have to move, they have to move. So as long as the demand stays high, that's gonna be a very positive indicator for people that are looking at selling their properties. But if that demand starts diminishing and there's less buyers in the marketplace, well, that's what happens. That's when prices start to go down. Point number 2, in today's market, there is a lot of equity and just about everybody has it. Now, because properties have risen so high, the difference between this market and the last market, and I remember this, in 2007, I was 27 years old and I owned 4 properties. How I purchased those properties was through 100% financing, and I was getting loans, quite frankly, I probably shouldn't have gotten. I did make it out of that market without having to do any short sales, but the point is that I didn't have equity when I purchased those properties. And back in the 2007, 2008 crash, so many people were buying 100% financing, 120% financing in some cases. It was nuts. And you basically just needed a heartbeat to qualify. Well, in this market, people put down a lot of money on houses. You didn't see that prevalent 100% financing where people really had no skin in the game. And when the market crashed in 2007, what happened was that anybody who bought in the last 2 to 3 years were already underwater just because of the cost to sell were roughly about 6 to 7%. So if you bought a property and you had 100% financing, you were underwater the day you bought that property. And so many people were in that position. In today's market, with the amount of appreciation, not only did people put down in general the 5, the 10, and 20%, you saw more conservative financing in this market. But the people who've purchased in the 2-3 years, they escalated in equity quite a bit. And anytime there's equity, most of those people will actually sell the property if they go into financial distress versus take it to a foreclosure or stop making payments. So what you're gonna see in this market is that there is a ton of equity out there. Now, don't get me wrong, if you start to see prices come boom, down, those equity starts diminishing. But as of right now, everything looks very positive because there's so much equity in the marketplace. Now, if you're someone who bought maybe in the last year and you did an FHA loan or a VA loan and you didn't have much money down on the property and you start to see a shift, watch the home value, watch your property's value very closely, because that is gonna be the case where you could slowly leak underwater because you didn't have enough equity. Point number 3, one of the things that happened in the subprime market compared to this market is back then, 2007, 2008, they had a ton of subprime loans, and I sort of just mentioned it. But you had a lot of people buying houses that had no business of buying houses, and they weren't qualified from the day they originally tried to buy a house. They had no business buying a house. Back in the crash, we used to close 25 to 35 short sales a month. And at that time, we had one of the largest short sale teams in the country, and we were helping people avoid foreclosure each and every day. So I could tell you firsthand the types of loans that people were given. Most of these people were just giving loans based upon a credit, having an active credit account and a social security number, but they had zero business buying it. Some of these loans were underwritten in a way where they didn't even verify their reserves they had in the bank. They didn't verify their jobs. They used to call these loans no income, no asset. You basically needed a heartbeat, and if you did have a heartbeat, you could get financed. In this rise of a market from 2013, 2014, we started to see things shift back up. There weren't those bad loans, there weren't those subprime loans that were basically set up to fail. And that is a large reason that that market crashed in 2007. When you have a lot of people that don't deserve to own a house, or they shouldn't have any business owning one in the first place, you can almost expect default to happen. And once all those defaults happened, that triggered a domino effect to the rest of the market. And then we had what was known as the biggest crash in the real estate market of all time. So the last point that I want to make is that you could follow the trend since the Great Depression. What you're going to see in the real estate market is that it's cyclical. Every 10 years you see a rise and then a shift, a rise and then a shift, and this has been happening since the Great Depression. So one of the things you're going to want to think at if it's a good time to buy or sell is I want you to look back in the history of recessions and look in the history of inflation in general. And what you're going to see is that typically when you have a recession, a lot of people from an investment point of view will actually pull their money from untangible investments like stock markets and paper-like investments and put them into brick and mortar like real estate, like gold, like silver. So you could follow the trends back. I'm not any economic advisor, but I do know that when there is a recession that people do tend to go more towards the brick and mortar investments as opposed to paper investments like the stock market per se. I feel confident that in the fact that that has always been the case, that I think you're gonna see that money be poured into the real estate market. Now, depending on how this recession hits us. Now, we are in the beginning stages of a recession. Anyone who's telling you that we're not hasn't done their research or they're lying to you, but a recession for real estate doesn't necessarily mean a bad thing. And I would encourage you to look up the histories of recessions and then compare the correlations you see with the real estate market and make your own informed decision. That is my opinion, but I'd love to get yours. Go ahead and comment below on this video. We'd love to see what you think. So overall, does this mean a crash is coming? Well, nobody knows the answer to that, to be honest with you. What we do know is we can look at past histories and take the 4 points that I just shared with you, and you're gonna see that the 4 major things that caused that crash in the 2007, 2012 market are not present in this market. Now, I'm not saying that a crash is not going to occur. We're not going to know that. We can't control certain things. But what I am saying is that as of this time, besides interest rates going up and real estate becoming less affordable for people, overall, it is still a good place to park your money, especially in a recession or inflation timeframe. So I really hope that this helps answer some questions and give you some insight on the San Diego market and whether or not it's going to crash. Overall, you want to talk to a real estate agent that understands this stuff. And I'm not talking about someone who just got their real estate license. Talk to someone who's been in the business for a while, that has been through the cycle shifts. And the advice and information that they can share with you can be the difference between you making hundreds of thousands of dollars on your next real estate investment and making $0 on your next real estate investment. So please feel free to go ahead and view the rest of our videos on our channel right here. My name is Mike Cuevas with Big Block Realty. If you have any questions, please feel free to reach out to us. Our team helps people buy and sell throughout San Diego County each and every day, and we'd be happy to help you and answer any questions that you may have, whether you're thinking about buying or selling your property and moving on to the next stage in your life. So don't forget to subscribe to our channel above and leave us some comments down here below, and we'll see you guys on the next video.